Good day guys and welcome to my dojo. In today's video, we'll be looking at the difference between expectational market structure and reality market structure. Understanding your structure is very crucial when it comes to trading because it simplifies you in terms of placing your stop loss and where to place your take profits. Without wasting time, let's get right into it. We'll start off with a expectational market structure, which is everyone's expectations when they come to the market structure or when they open their charts. They expect to see a textbook structure which will be higher high, higher low, higher high, higher low, and higher high, which barely happens in the structure. So without wasting any time, let me just break it down to you. This will be our low, this will be our high, and then meaning that this will be our low and this will be our high. So this will be our break of structure to the upside, meaning that we are now bullish. After breaking structure, market will create some sort of pullback into areas of certain demand before giving us another bullish structure which will now break our previous high, making another break of structure to the upside. And then again after it, the market will again create a sort of pullback into a certain area of demand areas, which will now create another break of structure to the upside. Another break of structure to the upside, meaning that we are bullish again. We will wait for market to pull back into another area of demand before we get another push to the upside, which will create another break of structure. But in this case, we get now this low gets broken. After this low gets broken, now we have a change of character. After getting this change of character, it simply means now we are no longer looking for buying opportunities. We are now looking for selling opportunities from areas of supply areas. That's why this is a textbook, because this is what everyone expects when they come to the charts. So let's take a deep dive into reality of market structure. Now this is what's confusing everyone, but don't worry, I'm here to simplify it for you. So we'll start again same way. We'll start from this low to this high. Remember, now when you come to the chart, we don't know whether this is a bullish or bearish structure, meaning we can't see anything that's coming after this blue line. Fine. So now we're gonna mark this low and we're gonna mark this high. Now this is our trading range. So now everything that happens in between these two lines will be now our internal structure, meaning that everything that happens inside is none of our concern unless you are advanced to trade the internal structure. So now we wait for the market to pull back as furthest as possible and give us the direction whether it's gonna break the lows or the highs. So in this case, we now broke the highs, giving us now a break of structure up. Now we know that we are now bullish because now we have now this low and this high. That is now our new trading range. So now for us, if we want to capitalize on this move, we will wait for the market to pull back into areas of demand, give us our change of character, which is our entry model, and then ride the wave to take out this high, which will now result in another break of structure to the upside, which will now leave again this low to this high as our trading range, meaning that anything that happens again in between these two lines from this high to this low will represent our internal structure. We wait for price to show us its hand again by waiting for it to pull back into certain areas of demand. Certain areas of demand give us our entry model, and we ride the wave again to break this structure to the upside, which gives us another break of structure. Now that leaves again this low, which is the furthest point which market pulls back before breaking structure to this high right here, meaning that we are trading from this low to this high. Anything that happens between these 2 points will now represent our internal structure. So now see what happens now. Eventually, market breaks this low, meaning that after this, we now know that this is our change of character, meaning that after this, we are now no longer looking for buying opportunities, but we are now looking for selling opportunities from certain areas of supply areas to take out this low right here, giving us another break of structure. Now we'll be riding the wave downwards. This is how you simplify your structure. This is what reality of the structure will look like when you go into the chart. Simplified. Do not get distracted by these internal structures. Let us look at it into now the chart. Now we'll be looking at it into the chart. We'll start right here. We had a break of structure right here. After this break of structure, we now know that we have this high to this low, meaning that anything that happens in between these two is our internal structure. We wait for price to give us a sort of pullback into a demand area, wait for our confirmation model, and then we ride the wave to break structure to the upside. So now we know that we are now bullish. If you take a look at this, we now have a new trading range from this low to this high right here. So now, meaning anything that happens in between these two is still internal structure. We'll be waiting for the market to pull back into certain areas of demand areas, give us our entry model, and then ride the wave to break the structure up, because we are now bullish. We are looking for buying opportunities. That simple as it is. We go again. If you follow structure again, you will see that we have now a pullback, which gives us this area as our high, and that low, this low will be now representing our low. Now, meaning that anything that's in between these two will be now our internal structure. We wait for a pullback, and then we ride the wave again to break now the upper structure, giving us a break of structure to the upside, and so on and so forth. This is how simple market structure can be, guys. If you know and understand what are you doing, you can read structure very much easily. If you look at the price here, we pulled back, giving us now areas of if you look, this is our high, this is our low. What do? We wait for market to either break the low or the high, so that it can show us its hand, whether it's going down or up. In this case, we broke structure upwards, meaning that after this break of structure, we wait for market to pull back into some kind of demand areas before we can ride the wave to take out the high, giving us another break of structure to the upside. Easy as simple as ABC. We're ranging from this low, this is our low, to this high. Anything that happens in between these two is internal structure. We wait for a pullback into a certain area of demand. We wait for a pullback into a certain area of demand, wait for our entry model, and ride the wave to the upside, giving us a giving us a break of structure because we are still bullish. So on and so forth. Easy as easy as easy. 2 points from this low to this high. No matter how long it may be, we must look for the furthest point that price pull back into before giving us a break of structure. So now after this break of structure, we have that low to this high. We wait for price to pull back into a certain area of demand area before it breaks to the upside, giving us another break of structure. A break of structure. That is as simple as ABC, guys. Like and subscribe to this YouTube channel. I'll be giving away a free PDF of a simplified how to read your structure, how to get your entry point, and how to take your profit. Everything that has to do with SMC that is simplified, I'll be giving it away. All you have to do is like and subscribe to this channel. We don't make anyone pay for any courses. We give everything for free, guys. I'll see you again into the next video. Sharp.